Good evening, everyone. My name is Nikhil Mansukhani from Ad Factors Advertising and PR, and I will be your moderator for this evening. On behalf of Shiram Properties Limited, we thank you for taking out the time and joining us today. We welcome you to the virtual analyst and brokers meet on the announcement of the company's forthcoming IPO. Before we begin, I would like to introduce the management and other distinguished guests who would be addressing today's gathering. At the center of your screen, from the management, we have Mr. Murli M., Chairman and Managing Director. To the right of your screen, we have Mr. Gopalakrishnan J., Executive Director and Group Chief Financial Officer. And to the left of your screen, we have Mr. Ramesh K.R., Executive Director, Operations. And representing the BRLMs, we have Mr. Raghavendra Pandey, Executive Vice President at Icici Securities Limited. Mr. Vivek Toshniwal, Executive Director and Co-Head, Equity Capital Markets at Axis Capital Limited.
Hello, good evening.
And Mr. Mangesh Ghogre, Executive Director and Head of Equity Capital Markets at Nomura Financial Advisory and Securities India Private Limited. We have placed all microphones on mute. Post the presentation, we will welcome questions. A sincere request to all to kindly type your respective questions in the Q&A panel available to you. And these questions will be read out to the management on completion of the presentation. I would now like to invite Mr. Raghavendra Pandey from ICICI Securities Limited to initiate the proceedings. Over to you, sir.
Good afternoon, ladies and gentlemen. I welcome you all to the virtual Brokers and Analysts Conference of Sriram Properties Limited IPO. We at ICICI Securities feel extremely privileged and honored to be associated with Sriram Properties. The residential housing market has performed strongly during the third quarter of 2021, with residential units sales experiencing the strongest results since the outbreak of the COVID-19 pandemic, despite the impact of the second wave. It is expected that market share of established and credible property developers like Shriram will increase with buyer preference skewed towards offerings from developers with proven track record, financial stability, and execution capability. Shiram Properties is one of the leading residential real estate development companies in South India, primarily focused on the mid-market and affordable housing categories. The company is among the 5 largest residential real estate companies in South India in terms of number of units launched between the calendar year 2012 and third quarter of 2021 across Tier 1 cities of South India, including Bangalore, Chennai, and Hyderabad. The company is part of the Shriram Group, a prominent business group with 4 decades of operating history in India and a well-recognized brand in the retail financial services sector and several other industries. Over the years, the company has been transitioning towards an asset-light business strategy with development of projects through JDAs, joint ventures, and focus on the development management, the DM business, by leveraging their brand name and execution experience. The company is led by Chairman and Managing Director M. Murli and is backed by marquee global and domestic financial investors. A little bit about the IPO. This IPO is a combination of fresh issuance of 250 crores and offer for sale of approximately around 350 crores. The shares price band is INR 113 to INR 118. The total issue size will be of, as I said, 600 crores. The QIB portion in the issuance will be 450 crores, the HNI portion of 90 crores, and the retail portion of 60 crores. The issue opens to public on Wednesday, December 8, 2021, and closes on Friday, December 10, 2021. We have received strong interest from all class of investors, both FIIs and DIIs, which is a testimony of how investors acknowledge the journey of this company. I would now like to hand it over to the moderator, and therefore the management team will take through the business presentation forward. Thank you.
Thank you so much, sir. I would now like to call upon the management of Shiram Properties Limited to take us through the company, its journey, and the investor presentation. Over to you, sirs.
Thank you, Raghavendra. Thank you. Good afternoon, ladies and gentlemen. It's my privilege and an honor to present you all about my company Shiram Properties. On behalf of the board and the entire Shiram family, it's my great honor to have you all in this conference. We are at an important milestone today in our corporate history. Hence, this meeting is very, very momentous for us. Sincerely thank you all of you from bottom of my heart. I'm joined by my colleagues, Mr. Gopalakrishnan, ED and CFO, Mr. Ramesh, Executive Operations. As an introduction, we are part of Shiram Group. You are all familiar with Shiram Transport and Shiram City and Finance. We have created one of the successful ventures in the financial services. This is another group company which is into real estate. As you know that we are coming into the capital market from the group after a long period of time. We started this journey for the real estate business for Shiram Group about 20 years ago. I was in L&T. I came into Shiram Group to set up the business for Shiram Group real estate business about 20 years ago. We are one of the best real estate developers with the leadership in core markets, particularly in South India and in Calcutta today. Building the organization again, Shiram Properties, in line with Mr. Tyagarajan's ethos or Shiram Group ethos of trust, transparency, and governance. These three are the basic parameters with which we built the entire organization. Of course, supported by independent board and very, very highly capable professional management was the core of our strategy. We leveraged Shiram Group brand very, very effectively and relentlessly. Focused on few themes like mid-market and affordable housing. That's one area we wanted to focus right from the inception, and also focus on markets where we are extremely comfortable, which is southern markets. Trust on asset-light model right from the day one, like joint developments and joint ventures. Moved on to development management because of the consolidation opportunity which drew us for large players like us. So we moved into development management, which is again another asset-light model. Very strong relationship built with all the stakeholders, just not only our landowning partners or development partners with institutions who brought us the land, also a lot of private equity investors. We are supported by large stakeholders like TPG, Tata Capital, Starwood Capital, Walton Street Capital. They collectively own about 58% of the company. Our strategy has worked very well for us, paved way for transforming ourselves to be the leader in real estate industry. We are one of the top 5 developers in the markets where we operate. We have presence in Bangalore, Chennai, Calcutta, Coimbatore, Vizag at this point of time. In all the 5 cities where we operate, we are in the top 5. Of course, Coimbatore and Vizag, we are the number 1 developer. The other 3 cities, we are in the top 5. We have successfully scaled up our annual sales volume in the last 3 years. We saw an opportunity or we saw a challenge which is coming to the industry, opportunity coming to people like us as a large developer 3 years ago. So we wanted to build the capability for the organization to have 5 to 6 million square feet of space to be delivered. So built an organization. 3 years time, last 3 years time, we have been consistent in delivering about 3 to 3.5 million square feet of pre-sales. So now the focus on building the organization, which has come in very, very handy today, of having delivered good successful track record in the last 3 years. Also, the current opportunity, particularly post-COVID, the consolidation, which is going to help us scale up much, much larger today. So organization is completely geared up. All this has happened because of various aspects. COVID is the latest one. Started from demonetization to GST to RERA. COVID has cemented the consolidation aspect. We have grown in the last 3 years with a CAGR of 45%. Since the RERA came in. Our quarterly run rate, we are looking at about 1 million square feet per quarter, which gives us a very strong edge in terms of market positioning and securing a very highly profitable project line. We have pioneered, as I said, the development management model. We become leaders in the markets we operate on development model. Currently, about 1/3 of our portfolio is in the development management model, which is further growing. It's a completely asset-light model. We take up the projects which are struck by other developers or which are struck, by other financial institutions. So that's a bigger opportunity we are looking at, and that's helping us to grow very, very big way. Also, this has helped us improving our profitability and returns in the recent years. Probably Gopal and Ramesh will take you through whatever, on the development management model. As we speak, we have got a very strong operating platform that's consciously built over the last few years. As a company, we have delivered 29 projects so far with a build-up area of about 17 million square feet. We have no material inventory in the completed projects. All our projects are fully sold, practically zero inventory. In the last 3 years, we would have, as I said, about close to about 10, 11 million square feet, out of which whatever the projects which are completed, unsold inventory is practically zero, which means out of about 10,000 units which has been sold in the last 3 years or nearing completion or completed, we hardly have about 20 units or something, which is close to zero. So practically no inventory. We have very strong development pipeline with about 35 projects and 47 million square foot of development potential. Very strong organization coupled with a strong pipeline should help in maintaining the growth momentum. Looking ahead, we are at the cusp of a new growth era. The outlook for residential real estate, as you all know, is extremely positive. As an organization, Shiram Properties is well positioned to benefit from this trend. As you know, residential affordability is at the multi-decade high, supported by low interest rates on the home loans, very strong and sustaining real estate prices, improving purchase power, which is another major aspect, lucrative payment plans by various developers, and of course, government initiatives, particularly last 18-24 months time, across various state governments, not only the central government, they have provided the leadership across various state governments in the markets where we operate, have come out with a lot of incentives for the home buyers and also quite long-term incentives. All that is helping us to grow much bigger and bigger. And also the work from home also re-establish the importance of owning a home. People were back to their basics. So that also has increased the demand in the housing sector particularly. In the post-COVID environment, industry consolidation is likely to accelerate further. I strongly believe that each region may not have more than 10 players. That's my gut feel. That's my view, which I have been very vocal in the last 4 years. The market is going through serious consolidation. Currently, I would estimate not more than 50 to 60 developers across the country, catering to about 90% of the demand today across the country. Each market, if we take, let's say Bangalore or Chennai or Kolkata or Pune, any market, if we take 8 to 10 real estate developers, cater more than 90% of the demand today. So that's a big opportunity for a larger branded players like us to seize this opportunity. Also, these large branded players is a new norm in the real estate industry, and it will continue in the coming years as well. It's difficult for, the entry barrier is becoming very difficult for some of the smaller players to get in and compete with the larger players like us. Hence, we see a very encouraging prospects for us. Apart from strong volume potential, the industry consolidation is allowing us to emphasize greater on the new development management model. We pioneered this model, as I said, in South India. We are the leaders in this development management model. The asset-light model, what we have gone into it right from the day of inception, and this development management model, which has evolved in the last 3 years' time, will accelerate our growth and also will help our improving our margin substantially. Probably my colleague will explain this more in detail. To conclude, we are a very trusted brand with a transparency, governance as our ethos built this entire organization in the last 20 years. A very strong parentage, the proven track record. The industry is presenting unprecedented growth currently, and we are fully prepared to capitalize this opportunity. Our strong pipeline, leadership in core markets, and strong operating platform that has been scaled up to as I said, 5 to 6 million square feet of annual volumes will support this. We are poised to grow strongly in the future. We therefore believe it's an appropriate time for us to take new investors and also list the company as we embark on a new growth journey. Let me invite Gopal, our ED and CFO, to make a short presentation to all of you on the company's investment case. I will come back to you guys on any question and answers post this presentation.
Thank you, Murli. Good afternoon, everybody. I hope it's visible. Let me start with the introducing Shiram again to say that we at Shriram Properties, we are a pure play mid-market and affordable housing company. We are probably one of the few professionally run real estate development companies in this part of the country. And we are part of the Shiram group, as you are aware. And apart from the strong parentage of the Shiram group, we also benefit from the support of 4 private equity investors, TPGs, Tatas, Walton Street and Starwood Capital, who together own 58% of this company. From the marketplace, through the efforts taken over the last 20 years of our operation in this segment, we have now emerged among the top 5 players in each of our core markets, Bangalore, Chennai, as well as in Kolkata. These are the 3 core markets that we have, and the 2 other markets where we have presence are single project operations. And so they're fundamentally large part of our portfolio cluster around the Bangalore, Chennai, and Kolkata, where we are among top 3, top 5 players in these markets. The second theme that we have played, apart from focus on South India, was the affordable mid-market focus. We have consistently focused on mid-market and affordable housing through the entire journey over the last 20 years. Today, affordable and mid-market housing has become a buzzword in the marketplace, both in the residential and the capital market. But fundamentally, Shiram has consistently focused on mid-market and affordable housing since inception. Looking back, we are about 83% of the delivered portfolio is in mid-market and affordable housing. Going forward, about 85% of our portfolio is in mid-market and affordable housing. So the themes have remained almost unchanged. The second one is we've built credibility, we've built a strong brand and reputation over the years through timely delivery of quality products in a timely manner. And we have delivered about 29 projects so far, about 17 million square feet of completed space. And we have grown consistently over the years, but the growth momentum has got accelerated post-RERA, when post-RERA environment has grown from a 0.6, 0.7 million square feet in FY 16-17. We have grown steadily and strongly over the last couple of years, over the last few years, to reach about 3.5 million steady state volumes in the last 24 months, 36 months. To support the strong growth momentum, we have actually assembled a very strong pipeline of projects, 35 projects in the pipeline with an aggregate development potential of about 47 million square feet. I must point out, we are not a land banking company, so the entire development potential comes from a combination of projects in the JV, JDA, our own projects in the DM categories, and do not belong to, except for one land parcel that we have in Kolkata, which is old Ambassador factory, which we acquired from Hindustan Motors and Government of West Bengal. We don't have a land banking per se, and therefore the entire growth is coming from projects already identified and signed up, and therefore they are come with a defined execution timeline in mind. As I said, we have no land banking except for Kolkata, where we have a 33 million development potential. We will develop only 10 million by ourselves, which is included in 47 million I talked about. The balance 20 odd million square feet will be sold as an FSI sale in due course. Through the entire journey, another theme that has followed, was that we have followed consistently, has been the asset-light nature of our business. We have, since inception, we have focused on JVs and JDAs to grow this business. And now over the last few years, we saw an opportunity in the form of a development management model that can be implemented. We pioneered this model in the southern part of the country. We have stabilized this over the last 3 years. Today, the DM model, as they call it, as we call it, the development management model or DM model, accounts for 33% of our project portfolio. It is 15 projects aggregating about roughly about 15 million square feet of development potential. So that's a very strong momentum that we have built over the years. Now, putting all this theme into some context of what our past performance as well as what our future looks like. If I look at the past performance into the volume, We have grown from a very small base in the pre-RERA environment of 0.6, 0.7 million square feet. Although consistently we have grown, we have nearly doubled our volumes year after year post-RERA. And that's the benefit of being a consolidator. And we have capitalized on the opportunity, and we have literally grown nearly double our volumes year after year. And we reached a level of about 3.5 million square feet by FY19. Notwithstanding an NBFC crisis in calendar 2019 or the last quarter of FY20 and a 5-month interruption due to COVID 1.1 led lockdown, we've still managed to stabilize our volumes in the 3.5 million square feet net volumes, which is gross minus cancellations, consistently over the last couple of years. For the current year, we have done about 1.56 million square feet during the first 6 months. As you are aware, second half is seasonally stronger period for southern companies, and therefore we are on a right course to sustain our growth momentum and continue our run rate. Currently, last year we did a run rate of about 1 to 1.1 plus million square feet on a quarterly basis. The second metric that shows gives us the comfort is the fact that our projects actually, when we launch it, we are able to achieve a very good sales momentum. What we measure ourselves is a metric called sales at launch, a chart that you will see at the bottom. The sales at launch is an important metric from our perspective. It basically shows us what percentage of project that we launched is sold during the first quarter, which is 90 days of the formal launch. How much of our project inventory is sold? We have worked hard over the years to reach that number of about 35-40% steady state sales at launch metric. It is very encouraging to see that despite COVID-led interruptions and the bounce back that happened in Q3, only very gradual recovery in Q3 and gained momentum in Q4 last fiscal, we still managed to achieve 34% sales at launch. This year, equally encouraging, first 6 months, 40% sales at launch. All this basically means is we are able to identify some micro market trends appropriately, launch product properly, and therefore achieve sales, good sales in the initial period. Therefore, we are de-risking the project in subsequent period from a construction perspective and a subsequent sales perspective. We are on a very strong growth path from a volume perspective. To support that momentum, as I said a few minutes ago, we have assembled a line of 35 projects aggregating to 47 million square feet of development potential. The chart on the right top shows the mix of these projects. We have a very strong mix of JV, JDS and DMs. And in all, we have about 26 projects aggregating to about 20 odd million square feet of development potential. And we have the remaining projects getting ready for launch, aggregating to about another 20 million square feet of development potential that we have in the pipeline going forward. The charts at the bottom primarily talk about the mix of markets and mix of our product mix. We do like to highlight the fact that we will continue our focus on mid-market and affordable housing. By that, what we mean is, in our mid-market, we are in the 40 to 80, 85 lakh rupee ticket size. In the affordable, we are in the 25 to 40 lakh of ticket size. And the others primarily include plotted development, which is nothing but a mid-market product. And so overall, we will remain a mid-market affordable player with 84% of our future portfolio also remaining in that segment. And Bangalore, Chennai will continue to be a dominant force in our portfolio, with Kolkata adding additional volumes since we have now ramped up very nicely in unlocking value from our Kolkata land, the only land bank that we have in Kolkata. Just to recap and summarize our key strength that is actually helping us be among the top few players in each of our markets. The strong parentage is a big strength for us, the Shriram brand, which is always identified. It's a very strong, powerful, middle-income consumer mindset brand, and therefore our natural focus on mid-market affordable therefore comes together to support our market strength, and backing of financial investors, of course, add further strength to our growth and growth funding requirements. We have over the years worked hard to reach the current market position. We are among the top few players, especially with the focus only on mid-market and affordable. Within those segments, we will be a big force to reckon with. The scalable asset-light model is another strength that we benefit from. We have consistently focused on it since inception. JVs and JDAs have accounted for over 75% of our portfolio, and that model will continue even in the future. The greater emphasis on DM is going to be an additional growth engine. DM, I'll explain the DM a little more in detail. But fundamentally, DM is nothing but an end-to-end solution for a smaller developer and landowners, where we take over the land parcel from the launch, from the approval stage. We do the entire project planning, product planning, product design, launch, sales, collection, construction, and handover to customers. All in the Shriram brand, all by Shriram manpower. We don't outsource any of this. Like in all our own projects, only the construction part is given to a large construction companies. We do project manage and we don't construct on our own. Other than that part, everything is managed by us. And that's therefore DM is a big growth engine for us. We built a very strong track record in terms of execution over the years. I will show a slide subsequently. Another strength that we have, as I started off saying, we are one of the few professionally managed companies, we believe. And if you look at the board composition, it's comprised of very strong people with track record and eminence. And I'll highlight them as we go through. Very briefly, flipping through a couple of pages, I talked about the parentage. Apart from the Shiram branding, the Shiram brand and the backing, as well as the private equity investor backing, we also have a very strong proven track record in having partnership at the project level. We do have people coming into the projects, join hands with them, execute the project, and move on. Some of the names are highlighted here, both domestic and international names. All of these names have partnered with us and have had a very good experience in terms of both exit as well as quality of returns that they have got. From a market perspective, I did say that we are among the top few players in each of our markets. This slide shows our market share on a launch basis, and this is by JLL. And if you switch the filter and show by the volume sold, the picture will be somewhat similar. We are among top 3, top 5 players in each of our markets that we operate. As I said earlier, another thing that has played constant in our mind through the entire journey of 20 years has been the mid-market focus. 2 reasons for it. One, the Shriram brand connects very well with the middle-income consumer mindset, and therefore it was a natural segment for us to go in. Second, we consistently believe that the mid-market affordable housing will remain the strong performer on a longer-term basis given where the India's housing market is. Therefore, we focused on it consistently. Some of the data in recent years clearly endorse our belief that the affordable and mid-market housing are the biggest chunk of organized residential demand that we see in the country. Some cities are here, but the trend will be somewhat similar in all the 7 cities that you will see. As you are aware, top 7 cities account for nearly 80% of organized residential housing demand in the country. In South, it is Bangalore, Chennai, and Hyderabad. In West, it is Bangalore, Bombay, and Pune. In the East, it is Calcutta, and in the North, it is NCR. So the top 7 markets will account for about 80% of India's organized residential demand. So our presence actually in these markets therefore helps us in achieving greater volumes, and that has been demonstrated consistently over the years. I'll talk about the development models more in detail, but fundamentally speaking, we have been focused on JVs and JDAs consistently over the years because that's actually a lesser stress on our balance sheet, and we don't do land banking, and therefore the balance sheet is light. The DM actually is a new growth engine for us. We embarked on it a few years ago. We pioneered this in southern India, as Murli pointed out. Today, we have successfully stabilized this business model. We have actually signed up and definitive documents for 15 DM projects, the development management projects, aggregating to 15 million square feet, as you can see from the top chart. This now accounts for a third of our pipeline. And that's a big strength for us because we believe we have gone through the whole learning curve, as you would see from here. For the last 4 years, we have been building this business. Today, 1/3 of our portfolio with comprising of 14 projects, 11 of them have been launched. Many of them are nearing completion. Actually, the first residential DM project, Shiram Blue, will be ready for handover by March, April 22. Our first plotted development DM project, Shiram Earth Mysore Road, would be handed over to customers during this year, which basically means we have gone through the entire life cycle of this project evolution, and therefore we know how to manage these partnership cycles. And that actually big comfort to us in terms of accelerating our focus on it and building DM emphasis further. We believe it is a scalable, sustainable, and profitable development model in the context of consolidating industry environment where smaller landowners and developers are not finding viable to do on their own. They're looking for big boys to play, handhold them. And that's where all large branded players will have an advantage. And Shiram, having entered this 3 years ago, will have an early mover advantage while our peers are following the DMs as a focus area now. It's a very attractive, profitable business from a developer's as well as landowner's perspective. We can discuss that more in detail as we go through the Q&A. Execution record is something that we have been very mindful of consistently over the years. As you may recall, I said earlier, we used to be a relatively smaller scale organization in terms of 1 million square feet or thereabouts in the pre-RERA environment. Since then, we saw an opportunity. We scaled up the organization to be capable of implementing 4 to 5 million square feet of sales, collection, construction on an annual basis across cities. It was Murli's vision at that time, said that the industry will consolidate, it will present a large opportunity, therefore we should be consolidators. And that is the context in which we actually picked up some of this. We enhanced our bandwidth, we built an organization strong on systems, controls, and also leveraged technology, both for construction as well as our support activities. Today, we are a very well-oiled machine which is capable of handling 4-5 million square feet on an annual basis, both in terms of sales, collection, and construction. That ramp up, as you know, this takes time to complete and hand over. The ramp up is now beginning to show strength. Between FY17 over the last 4 years, we have delivered close to about 8 million square feet of completed space to customers. Despite an NBFC crisis in end of 2019 calendar year, 5 months of interruption due to COVID 1.1 lockdown nationwide, as well as a lockdown during a partial lockdown or a interrupted operations during the first quarter of this year. Despite all of this, we have delivered about 1.8 million square feet in the last 18-20 months alone. Not just in terms of scale of delivery, the efficiency of our construction operations also improved. We used to take about 5 to 8 years to develop from the launch to handover. We used to take anywhere between 5 to 8 years to complete these projects depending on the size and scale, as you can see from chart on the bottom. We have already improved our operations to about 5 to 6 years for some of these projects, and we are now committing under RERA, which shows our level of comfort and confidence. We are committing under RERA for 3 to 5 years for these projects now, which basically means improved cycle time by leveraging construction technologies. We're using aluminum formworks. We can discuss that more in detail. And therefore, the cycle time reduction will mean improved profitability for us. I'll talk about all this subsequently. So overall, if you look at, as I said earlier, the board is a very strong board. It's a board-managed company, consistent with the trend that we follow across Shiram Group. Murli actually is the chairman. Built this business for Shiram, has been the driving force in transforming this business from a new entrant to a market leader in the south. And we have a representative from Shiram, 2 representatives from the PE, private equity investors, and we have 4 independent directors, people of eminence, as you can see from here. From a management team perspective, Murli has taken efforts over the last couple of years to assemble a strong set of people. People have been with the company for some time now, have been the driving force in executing the strategy that we have been embarking on, and that has actually paid rich dividends over the last couple of years. The last piece I want to talk about before I go into strategy is about the COVID and how we managed to overcome, and also how we see as a sustainable, strong residential outlook. As you may have seen some of these charts earlier, markets went down into tailspin when COVID 1.1 led lockdown happened, because it was an uncharted territory for most players, most stakeholders, including customers. So sales nosedived, but started coming back very nicely since Q3 last year, Q3 fiscal 21. These are all data from publicly available sources and JLL as an industry expert. Markets have now come back. The level of interruption that we saw when COVID 2.0 lockdown happened or interruptions happened, because the markets have evolved now, the playbook is already in place. When the first COVID lockdown happened, Developers did not know how to handle, lenders did not know how to handle the disbursements, and in the absence of physical documents, customers did not know how to react. All of this, I think we have gone through a learning curve. COVID 2.0 proved to be an endorsement that the markets have evolved. We have, in the first half alone, from a Shriram perspective, we have sold over 0.56 million square feet in first half, despite the fact that 50 out of 90 days have been a lockdown. That clearly shows that customers have evolved and are willing to take decisions, notwithstanding their constraints in terms of visiting the sites. E-marketing initiatives, ground shoot based site visits, virtual walkthrough of model apartments, all virtual negotiations have all actually evolved and reached and stabilized. So the playbook is in place. Tomorrow, if something goes wrong, somewhat similar or something similar to what we have gone through as in the last 2 years, I think the market has now evolved itself in terms of sustaining business operation with a limited interruption. More important, last point I want to deliver on this slide was the market itself is looking positive for a simple reason that the residential sector, the affordability of residential housing is at a multi-decade high now. Historically low interest rates, lucrative payment plan from developers, incentives from government, very stable real estate prices and a purchasing power. All of them coming together to make the affordability at a multi-decade high. Some of the experts in the industry point towards a 25-year high in terms of an affordability index. So that is an encouraging sign. Therefore, the recovery that you see in these charts here are not a pent-up or an aberration. They are sustainable long-term trend in our view. The work from home has accelerated this trend further, and therefore they are adding further strength to the overall demand conditions. COVID has actually played another acceleration game on the consolidation. Industry has been consolidating ever since RERA came in. GST and demonetization played a role as well. The smaller players no longer find it viable to operate in this sector. It is the top few people who will actually dominate or who will control a large part of the market share going forward. Some of the charts are only for 2 cities, but you can see similar charts from research reports as well as industry expert reports in terms of across all 7 core cities that I talked about. The top 20 players now consistently account for about 50-60% market share in most cities, and top 10 even impressive turnaround from where they were 3, 4, 5 years ago. That consolidation game with a strong brand and a proven track record for Shiram, we believe will be a big support in terms of transforming ourselves and sustaining as a very strong player going forward. Recapping some of the numbers from an industry KPI perspective, sales volume, value, collection and construction, key metrics that we look at. We have been able to stabilize around 3.5 million, and more importantly, this FY 2021 reflects some of the cancellations that we would have seen due to the pandemic and associated concerns, including NBFC crisis of November, December 2019. The quarterly run rates are stabilized around and averaging around 1 million square feet plus. That's a very encouraging sign for us. And despite a 50-day interruptions out of 90 days in the first quarter, we still managed to clock 1.6 million square feet of sales in first half, as you can see from this chart. Our collection trends have been very strong and stable through the entire COVID period last year. We came back quickly after a very short period of interruption in collection. We came back very quickly to pre-COVID level and has been very strong throughout since then. Construction trend, we did suffer a little bit in FY21 because of labor migration issues, but we got back most of our labor count post Diwali last year, and since then we have been able to maintain from a pre-COVID level of 4,000 laborers across all our sites. Though they don't belong to our books, these are contractor laborers, but the laborers are in our site, and that's how the construction momentum continues. Against the pre-COVID number of 4,200 headcount, we went down to as low as less than 1,000 during lockdown last year or post-lockdown last year. But since then, last Diwali, November, December last year, we got it back close to about 4,000. Now we are in excess of 5,000, and that's maintained even during the interruptions during early part of this year. That gives us the comfort that catch-up of milestones in construction will be very smooth during this year, and therefore we should be able to deliver our results. Looking at strategies, there are a few things that have worked very well for us in the past. Continued focus on mid-market and affordable housing has played very well for us. Thrust on southern markets have worked very well for us. We will continue same strategy going forward as well. We will also continue to leverage our relationship with all our potential financial investors at the project levels as part of our growth funding strategy. We will continue to focus on building scale and size and also further enhance our capability. As I said, we have built ourselves for a 5+ million square foot of annual throughput, be it sales, be it collection or construction activities. We have put sufficient strength in control systems to support this kind of rapid ramp up. And those are all stabilized, well-oiled machine now. So we'll continue with these 4 parameters of our strategy even in future. The 2 new angles to the strategy that we brought in was the DM Trust and Kolkata monetization. I'll talk about this very briefly and then I'll pause for taking Q&As. DM has been a very strong growth engine for us over the last couple of years. It was our vision and a strategy that we had that DM would be a growth engine for us. DM will be a big accelerator for us in terms of consolidating or gaining from the industry landscape change post-RERA. We saw this model working fine and we pioneered this model in southern India. Since then, we have signed 15 different DM contracts. I can explain that more in detail, but fundamentally, it's an end-to-end solution for smaller landowners and developers who are either stuck or in the post-RERA they are stuck or post-COVID they are stuck, or this will help new landowners and new developers in terms of getting the comfort because they are not able to do on their own. They will look for big boys to handhold them, and that's where we come into play with the focus only on development operation and no land banking. For us, it's a much easier task to be a leader or in hand-holding these troubled or smaller landowners and developers. That model has worked well, stabilized. We believe the opportunity is very large in this segment. Therefore, we can actually run this for a much longer period as we go through in future. Bengal has been the last leg of our strategy, has been in the works for some time. As some of you may recall, we acquired this land bank almost 10 years ago. It was a sale by Hindustan Motors. This is the old Ambassador factory in Kolkata. Came from Hindustan Motors in Government of West Bengal. It took some time to get approvals. All that is behind us now. 2016, FY 16-17, we got the approvals. And since we launched that in 2016, and since then the journey has been very smooth. Being a very large project, we do believe we cannot develop entire thing on our own, and therefore we devised a strategy that we will do out of the entirely approved for integrated township, 33 million square feet of multi-format development. We will focus only on mid-market and affordable housing. Therefore, we said we will do 10 million by ourselves between mid-market, affordable and plotted development. The remaining 20 million square feet, we will invite others to part develop, and therefore it will be an FSI sale to others. We have progressed both by now. Our own development part, we launched our first project in FY 17, Shiram Grand 1. That is a 2 million square feet development, 2,400 units, almost entirely sold from our books now. We are getting ready to start handover starting end of this fiscal. So that site will start seeing green shoots by people, 2,300 families coming into the site over the next 12 to 18 months. The second phase is a joint venture between Shiram and Kotak India Affordable Housing Fund, which has 2 investors, CDC and Kotak. We both have economic interest partnership there. And that project was launched 2 years ago, previous Dashara, 1 year ago. My apologies. We have sold, we launched it in 3 modules. The first module with 800,000 square, it's a 2.4 million square foot of development, 3,000 odd units, 100% affordable unit, whereas the first one was affordable in mid-market. Out of 800,000 square foot we launched, we sold almost 700,000. This Dashara, few weeks ago, We have launched the second module, another 800,000. In the process of soft launch now, to correct myself. So we will be embarking on a formal launch fairly soon. And therefore, combination of this over the next year or so, we will be completing this and we will embark on the next set of our own development. In all, the entire 10 million square feet of our own development, we expect to be completing in about 3 to 4 years. FSS sale has also started gaining momentum. We have sold some land for senior living. We have sold some land for social infra like schools. But we expect to have more momentum in the coming months or coming quarters. And we expect to be able to monetize this FSS sale of 20 odd million square feet in about 3 to 5 years time. So therefore 5 years from now, we should be completing and exiting this project in Kolkata. Overall, that's fundamentally what our strategy is all about. I'll talk about the financials as part of the Q&A. But to sum up, very strong brand, a trusted brand, built credibility over the years through relentless focus on quality and timely delivery, proven track record, and we have a very strong growth outlook supported by a positive industry environment and a very strong pipeline that we have built. It's a very scalable business model. We have demonstrated our capability to scale up from 1 million plus square feet on an annual basis to about 3.5 million square feet already. We're running at 1 million square feet per quarter run rate. We should be able to scale up as the opportunities evolve. We should be able to scale up very comfortably with a minimal expansion at the bandwidth. Industry consolidation is presenting a very large opportunity in front of us. We should be able to capitalize on the trend in the marketplace with a strong balance sheet, a low leverage. We should and access to capital. We should be able to therefore embark on the next leg of our growth journey. And that's why we thought this is an appropriate moment to invite a new set of investors into our balance sheet and provide a liquidity even for our existing investors who are part monetizing their holding. They will continue to stay with us. Their combined holding is 58%. Post IPO at the upper end of the price band, they will continue to own about 34% or more. And therefore, they will also partake in our growth journey going forward. Plus, we will be able to get the new set of investors who will support us in the next leg of our growth. And that's the context of our IPO. I'll stop here and I look forward to responding to some of your questions. Thank you.
Thank you so much, sir, for that in-depth presentation on Shiram Properties Limited. We'll now move into the Q&A session. While we have already received some questions and we'll be taking those questions first, a gentle reminder to all to kindly type your respective questions in the Q&A panel available to you, and we will try and ensure that all questions get answered. So coming to the first question, you mentioned that you're the largest developer or in the top 3 developers. Could you throw some light on what parameters these are based on?
So we are among top 3, top 5 developers in each of our core market, both in terms of number of launches as well as the sales volumes.
Thank you, sir. Sir, could you also comment about the company, about the performance of the group company Orient Green, as many shareholders have not done too well over there, and the public has invested in a Shriram group company over here. So could you comment on the performance of that company?
Our focus is on Shiram Properties now. It's better we stay focused on Shiram Properties.
Thank you, sir. So who is the selling shareholder who is selling at a loss compared to the average cost? Also, what percentage of his shareholding is this person selling? If you could throw some light on that.
So none of them are exiting this company, just to clarify. Okay, all 4 investors who together own 58% of the company will continue to be with us. They are selling, each of them proportionately divesting a part of their current holding. And therefore, their view is very simple. They will be part of the same journey as we go through the growth curve again. And therefore, this is only a liquidity event for them to create a publicly available benchmark for their holdings. Each of the funds have their own fund life constraints as well as fund benchmarking requirements. And they have been with us for about 4 to 7 years, depending on which name we talk about. So therefore, it may not be appropriate to look at it as a sale at a loss, where they're only part monetizing their current holding, and they have a view on where the company will head as we go through the journey, and therefore view on timing of their sale, and therefore overall realization of value for their original investment.
We also looked at considering the current consolidation opportunity today, and where we can, as an organization, in the next 3 to 5 years' time. We also so we strategically looked at very attractive pricing. That's the opportunity we looked at, and our partners, existing partners, considered it as a very positive move, and they also reissued their commitment to stay with us in our growth story. Hence, it should not be seen as a price reduction. Should be seen as a strategic move to capitalize the opportunity which is likely to come up in the next 3 to 4 years' time.
In fact, they have scaled down their selling quantum.
Yeah. Originally, they started with a bigger number for offer for sale. Then, they looked at the prospectus of the company and what it can achieve in the next couple of years' time. Then they looked at, why not we reduce the offer for sale. So that's what we achieved now.
Thank you so much, sir. Sir, could you throw some light on the last computed NAV of the company? And also, how do you define the category affordable housing?
So I would prefer the question on the NAV moves to the banks. We wouldn't be able to comment on NAV in this context. They're all block period. From maybe one of the bankers can address that.
Yeah, Gopal. So as on 30th September 2021, for which the last updated financials in the RHP are provided, the NAV was 51.8 rupees per share.
On the affordable housing segment, we fixed up as 45 lakhs, 25 to 45 lakhs is affordable housing. Sub 25 lakhs or maybe sub 20 lakhs maybe for economic weaker section, which we are not present. Affordable housing is 25 to 45 lakhs. 45 and above, maybe up to 80 lakhs is a mid-market segment. In the markets where we operate, this number cannot be applicable to markets like Delhi or Gurgaon or Bombay. This is applicable to markets where we operate. So that's the framework with which definition with which we have been operating. As you know, that Government of India also has announced affordable housing bandwidth as 45 lakhs. So that goes in sync with what we have been practicing for a longer period of time.
Thank you, sir. Sir, coming to the next question, does Shiram Properties carry out construction of its projects, or are the projects being constructed by contractors?
We do not do it ourselves. We employ third-party contractors like Shapurji or M4 or LMW or BL Kashyap, Simplex. These kind of grade A contractors we employ for them to do our projects. And we do not undertake construction on our own, either for our own projects or outside also. We are purely a real estate developer. We spent this opportunity. I was originally from L&T. I came from L&T, so I knew the difficulties of contractor or being a contractor and as well as a developer. So right from the day one, we distinguished the difference of how do we differentiate ourselves being a developer per se developer. So we are one of the first mover to differentiate right from the day one, and that has been paying huge dividends. Now I'm happy to see every other large developers are also following. Most of them are following our model.
Thank you, sir. So, do you give the option to your customer who has booked a property to exit And if yes, then what percentage is forfeited out of that?
It is all governed by completely RERA. It is not in our control today. Earlier, pre-RERA, there were options and all that. Now, RERA has defined, every state has got, it's all governed by overall RERA. Government of India has prescribed. Every state has formulated the framework. We strictly follow RERA framework. So, whatever they are saying, we will do that. It's all completely monitored. Sorry.
As per RERA, it's a booking amount can be forfeited if it's a convenience of the customers, which we allow with 10% as the forfeiture of the total value of the product which he has bought.
Thank you, sir. And sir, what would be your strategy to compete with the huge competition in the Bangalore market?
People are competing with us, to be honest. So, and we see not many competition will come up from the organized players. We are the leaders in the markets where we operate. Maybe we are in the top 5. But we are a very dominant player in the markets where we operate, particularly on the big market and affordable housing. We have mastered this act on delivering projects within the cost and within the timelines, with the parameter and the value for money what we can offer to the customers. I think we have mastered that. So, and we see some more competition coming up for us. But since we have achieved the leadership position and we've been practicing all along, I'm sure we'll be able to navigate this as well.
Just to want to highlight the fact that I remember mentioning this, the sales at launch number is another indicator of this whole strategy, right? If we are able to sell 35-40% of our launched project within 90 days, and we have zero inventory in completed projects, all that speaks volumes about the market strength that we have.
Thank you. So what's the average completion period of a project from the date of its launch?
About 3 to 5 years is what we are targeting, depending upon the size of the project. For example, let's say it is about 1 to 1.5 million square feet, we target about anywhere between 3 to 4 years time. If it is a larger project, let's say 3 million square feet, we take about 5 years time. So we have scaled down this quite a lot in the last 3-4 years by bringing in a lot of new technology in construction methods, and also some of the procurement plans what we have been practicing now. We've been able to bring down earlier. We've been able to bring down the last 3 years close to about 40% of the timeline, and also it helped us in reducing the dependency on unskilled labor to a larger extent. Over and above that, we have also been able to contribute quite a lot on the environment and ecology. Some of our buildings, in fact, they got gold rate and platinum rated from the Green Council lead rating for green energy buildings. So we have moved quite a lot on this aspect.
Interest and tax for the last 3 years and the first half of FY22.
So our free cash from operations all of financing voluntary prepayment of some of our loans. I just want to clarify, we don't have a land bank, and therefore we don't have any debt associated with the land bank. So entire net debt of about 700 crores we have is mostly related to project level construction funding. And while each of these projects can fund on their prepay on their own, without the acceleration of the voluntary prepayment will help us reduce some burden and improve cash flows at some of these projects, especially when they are coming back from the post-COVID collection recovery. We thought that reduced burden will help them in accelerate pumping more collections towards construction. Therefore, we did that voluntary repayment in some of our existing facilities. But otherwise, operating cash flows have been fairly strong and healthy.
Thank you, sir. So what is the percentage of top line taken as fees for DM?
So over the last couple of years, the share of DM has moved up gradually as the DM business itself got scaled up. FY21, we had about 100 odd crores as a DM out of 500 crores of revenue that we realized. And first half, about 150 crore of the overall revenues, out of which 32 crore was the DM revenue.
Thank you, sir. And sir, could you please share details?
If I can supplement, sorry, one supplement.
Yes, sir.
I think more than as a percentage of overall revenue, because we are targeting to hand over large number of units, because as you know, whatever we did over the last 2-3 years in terms of ramp up from 1 million square foot to 3.5 million square feet, they all come for handover. Therefore, as a percentage, it may not be an appropriate number, but where will a steady state DM cash flow, what is the annual DM inflow would be a more appropriate indicator, and last year we had about 100 odd crores.
Thank you, sir. Sir, a follow-up to that is, could you please share the DM model economics in detail, the revenue share and risks, if any, and the competition going ahead in the same on revenue share, as other developers also join the fray?
Absolutely, very good question, and thank you for asking. I think let me give you a very brief overview of the DM model itself. Right, it's fundamentally a turnkey nature. Landowner comes to us with an approval or with approval in work in progress. We take over from there. The assets and liability remain in the books of the landowner company, which we don't own. So it's owned by a landowner, and the assets and liability remain there. We are primarily a service provider, end-to-end service provider. We take over from there, we do the product planning, design, development, launch, sales, collection, construction, and handover. Entire chain is done by us. For that, we charge a core DM fee of about 12%. Depending on what all we incur and what all we ask the DM partner, the SPV, to incur, the rate ranges from 12% to about 20%. If all costs are incurred by us, so it's a pass-through. So it's like a Lego game. We just block, you plug in, plug out. So therefore, a core DM would be about 12%. This is a weighted average number of 15 contracts that we have signed already, the actual contract, not an expected number. This is just a weighted average number of all the contracts that we have signed. Out of this 12%, being a core DM, because sell channel partner commission, selling expenses, all that belongs to somebody. If I have to pay for it, then all will be grossed up, so the 12 will go up. The 12 is a core DM. Out of that, I incur only the allocated manpower costs associated with those projects. That will be about 2-3% max. So 9% plus is 9% of project revenue will be the EBITDA or PBT from our perspective. Just to clarify, we don't recognize anything else. We recognize only the DM fee. Therefore, the DM fee will come into my P&L. Only allocated manpower cost will be deducted, therefore it will be a high EBITDA margin and the state flows through the PBT. There are a few things that I want to actually highlight. The improving share of DM or improving DM flow along with the operating scale is a big contributor for improving margins. We have already shown a meaningful growth or recovery or improvement in margins over the last couple of years in EBITDA level. With the operating scale building up and revenue recognition happening, as you know, we can recognize revenue only when we complete and hand over. So when those revenue recognition come to us over the next 12-24 months, we will see the operating leverage kicking in, plus the flow of DM fee which flows through the P&L will help us in improving earnings, profitability, and returns.
With respect to
the so the DM therefore is a scalable opportunity, sustainable opportunity, and a profitable opportunity. There are two ways to look at the profitability, right? This is what I explained so far is our profitability. If I look at from a landowner perspective, DM, the landowners can develop land parcel only in 3-4 ways. Sell the land and move on, develop on their own and sell constructed unit, construct and hand over, like do development on their own. Or JDA, JV type structure or DM. We've done some number on this. Happy to share with anybody who is interested in a one-on-one basis. Fundamentally speaking, the landowner makes the second highest NPV cash flows on any land parcel on the same assumptions across. In DM as the second largest cash flow generator for him, other than his own development. His own development comes with all range of risks in terms of under the current era, sales are not happening for smaller brands. Larger branded player is the theme. Therefore, he won't be able to sell. He won't be able to get the same price the large branded player can offer. I'm not talking only about Shiram. It is true for all large branded players with established track record. Will be able to do DM more efficiently. Therefore, under the same assumption also he generates only when he develops on his own he will be able to generate this higher cash flow than DM. Therefore, landowners are seeing it as a win-win solution. That's one of the reasons why we have got 15 definitive agreements signed with 15 different projects, of which 11 of them launched already under the DM in the last 30 odd months.
It's not only the landowners, the lot of financial institutions who have been stuck lending money to the developers who are not being able to complete the project or deliver the project, they are all coming to us. It's just not the landowner. So we see a bigger opportunity. Out of this 15 projects, close to about 7 or 8 projects have come through financial institutions who have lent money to other developers who could not be, they could not complete the project. That's increasing further and further. Today, market has reached a stage today. Only large players like us or branded players like us can only sell. Rest or the people will be difficult to will find it difficult to sell. So that's one bigger opportunity. The other question you asked about the competition. Yes, we started witnessing competition coming up in a big way in this development management model. But we sensed this opportunity about 3.5 years ago and build a platform, build a organization to take care of it. And as you know that we have right from the day one, right from the inception, we always focused on asset-light model and partnership model to grow our business. This came handy to us to master this development management model. So we have become master in this development management model. As Gopal said, 15 projects already in our portfolio. Close to 1/3 of our portfolio is development management. What we understand when the other company, I don't know that talk about okay. So a lot of people are coming into it. I'm restricted by our colleagues not to speak other competition. But what I understand, some competition who did not look at DM some time back, today they have been aggressively looking at development management projects.
Thank you, sir. So what's the inventory level and what's the average time it takes to sell apartments from launch to completion?
So currently we have close to zero inventory in completed projects. We have almost 10,000 units completed and delivered, out of which we have less than a handful of units unsold. So it's close to zero. Ongoing project, as I said earlier, we have about 20 million square feet of ongoing out of 47. Out of that ongoing projects, we will have about 80% is already sold, the remaining will be sold. The way we work is very simple. We try to achieve half of the sales volume in the initial period. As I said earlier, our sales at launch metric, which is 1 quarter from the formal launch, 35-40% is sold, and then we try to achieve that number. And then as the construction progresses, we try to sell as the pricing also improves, right, from our perspective. Therefore, we continue to sell. What we call this is sustenance sales is nothing but the ongoing projects sales volumes happen. And typically, and as Murli said, a 3-year project, we would have completed sales in about 2 years, and the rest remaining last year would be focus will be primarily on completing in a timely manner and handling. That's our sales cycle usually.
Thank you, sir. So do we prefer to venture into new markets like MMR and NCR, or would we prefer to be a market leader in the existing markets?
Our preference is to stay focused on the markets where we operate today. And we are already, a leader here in the markets we operate. We have got a portfolio about 47 million square feet. For the next 3 to 4 years of growth, we have got enough projects already lined up, and all the projects are in very good shape today. If you are able to deliver these projects, we could scale up quite a lot. Having said that, we are not looking at NCR region, MMR region, and Pune. It's all good market, but we are not looking at today. We'll be very, very opportunistic, whatever the market we look at. But current focus is on South India, mid-market, affordable housing.
Thank you, sir. And sir, any plans to enter into the commercial, retail, and hospitality segment?
No.
And could you throw some light on what you plan to do with the large amount of debt that's on the books?
As I said, our debt is not very large. We are actually one of the low gearing companies in this sector. Currently, it is 0.85 as of September. It used to be around 0.7 earlier. Now, if I look at purely from operating cash flows itself, the debt equity should go down. As we have been disclosed in the RHP, we would be using a large part of the primary proceeds to voluntary prepay our existing debt. As I said, it's a construction finance, but we would like to repay. So 200 crore out of 250 crore primary will go for debt repayment. And therefore, we expect the gearing to drop below 0.5:1 very comfortably, since we are at 700 crore debt today, and should go down to less than 500 crore purely because of primary proceeds alone, leave alone the operating cash flows. And we have a good comfort on the source of operating cash flow for growth funding. Should we need more growth funding, we can always re-lever the balance sheet if required. But this process also will allow us to restructure, re-look at our cost of funding. Currently, we are about 13% plus as a cost of debt. We see an opportunity there, and therefore we would use this prepayment as an opportunity to bring down and then look at if there is a need for additional funding requirement, can always be done in a more cost-efficient manner going forward in the future.
Thank you, sir. Sir, what is the capital employed in the Kolkata project?
The overall capital is about 350 crore roughly, give and take. And that's primarily we acquired many years ago, and it's equity funded. And now we are in the process of unlocking.
Thank you, sir. And so what kind of sustainable margins do we target in affordable housing as well as the mid-market housing?
Overall, as a project portfolio, when you look at, we aspire for let me put it this way. Our project evaluation always has been and will continue to be on a overall sustainable margin in the project as well as the time duration it takes. So the multiple as well as IRR is the significant criteria that we use. We usually don't take projects that don't deliver at least a mid-20 EBITDA margin at the project level. In the past, even though each of our projects would have been profitable, we lacked the scale. And because we were building up the organization, our revenue recognition would be deferred. As we hand over, only we can recognize. And therefore, when you're riding, this is a one-time evolution, right? When you ride from a million and a half square feet all the way to 3-4 million square feet, when you go, the journey during the period, your current costs are current. Revenues are deferred because you can recognize revenue only when you complete an handover. And therefore, there's a mismatch period. That is why you see the historical financials in the RHP show you a negative earnings. It's primarily because we are going through the devolution. Now that we have reached very close to the steady state point, and we have reached the 3.5 million square feet now, organization was built for 5 plus million square feet of capability. And therefore, when the full scale reaches, the operating leverage comes in very naturally. And therefore, we believe the disadvantage that we had, right, will disappear. And therefore, the project or profitability will not translate into the company. We believe we should be in the, if not more, industry average margins are sustainable in our context as well.
So you've been launching 3 million square feet annually for the last 3 years. So do you see yourself scaling up is a 10 million square feet annual sales during this decade possible? And do you have the team and the organizational strength to execute at such a large scale? Your views on that?
It's not the launch, it is the pre-sale what has been achieved. Last 3 years, we achieved a pre-sale of about 3 to 3.5 million square feet of pre-sale. Launch numbers are different. We have built an organization to do about 5 to 6 million square foot 3 years ago. Consciously, we built the organization to deliver 5 to 6 million square feet. 10 million square foot is stretched now. We need to build this next level of growth. So we'll start focusing on building the organization to scale up much larger than 5 to 6 million square feet sooner. That's where my time is going to be spent.
So I think just to supplement, Murli, we have currently, it needs a very minimal expansion from where we are today. So it's not going to take a lot of time and energy and effort. Yes, a lot of Murli's time will be going into strategizing those. But fundamentally speaking, we would be very comfortably reaching whatever we're aspiring for the current leg of growth. Moving from there, right, as Murli said, and I also highlighted that we built this organization for a 5+ million square foot of annual capacity, annual throughput. We're running at a million square foot run rate already. So therefore,
Million square foot per quarter.
Million square foot per quarter run rate. So scaling up beyond that would take minimal effort and it will be much easier. It is much difficult to ramp up scale up from a million square foot company to a 4 million square foot company. That we have, I think, managed to successfully stabilize over the last 24, 36 months. And therefore, we see a lesser challenge in ramping up beyond where we have set out for ourselves. By the time we reach in terms of volumes, I'm sure organization can be ramped up quickly.
We're building the capacity for 5 to 6 million square feet. Consciously, we brought in a lot of technology as an aspect for the growth. And we, positioned ourselves internally as a real estate service provider. So, a lot of technology has been brought in, automation has been brought in, robotic tools have been brought in to scale up. That's a reason with which we have been able to quickly move up from sub 1 million square feet to 5 to 6 million square foot potential. And so, proof of record is that last 3 years we had done about 3.5 million square feet, despite COVID, impact and all that. Hence, scaling up from 5-6 million square feet to whatever the size and scale, I don't see a big difficulty, but I need to put in effort. Probably in terms of parallel, you could say in terms of value, philosophy, technological expansion, we could be of similar to Infosys in real estate space. That's a positioning we could consider. We use a lot of technology which we already brought in to scale up further.
Thank you, sir. So there are a couple of questions with regards to the workforce. The first question is that the attrition run rate for our organization for the last 3 years has been in excess of 30%. So could you please share your thoughts on why the attrition rate has been so high and what are our plans to ensure that we get this number down?
So the last part, interesting question, and I'm very impressed. We have gone through the data in detail. Whoever asked the question, I think you are moderating it. Thank you for asking that. You would have noticed, therefore, while doing this analysis, that most of this clusters around the sales marketing team, which is very natural for this sector. Where if you look at the peer group, I'm sure there are enough publicly available data on the competition. I would only suffice to say it's not unusual or uncommon in this sector to have a large movement of sales force because few large players in each region and therefore people keep moving around. We are working towards in aligning interests of various stakeholders to ensure that this ratios comes down. But it would remain. We believe it would remain concentrated, or the risk would remain concentrated around the sales marketing force. You may have seen the numbers in other functional areas, including CRM, engineering, and the support functions, control functions. We usually don't see that kind of large movement around. And sales is a very natural. We keep taking industry comparisons by leveraging the knowledge of industry experts. And we do believe somewhat similar trends we see in other players. Having said that, we are not ignoring that. We will work towards aligning all stakeholders and see if we can bring down these ratios through incentive mechanisms, retention tools, and so on and so forth. But it is not an uncommon problem that residential real estate developers, at least in this part of the country, face.
To supplement what Gopal said, close to about 50% of our employee force, which is on sales. As an organization, we decided to concentrate on few areas. One is on the product design. Hence, we have got a very, very strong product development team. Then there's a market intelligence team, very strong market intelligence team. We can smell an opportunity in the markets where we operate quickly, what can sell, what cannot sell, and what should be the price band, how soon we can sell. So those areas. And a very strong project management team. We don't have a construction management team. Like, some of the organizations, they employ a large number of people for construction management, which we outsource to third-party contractors. And we take them into confidence on the day one. So they do that aspect. We also have an outsourced model of PMC. We give it to PMC for established, like established players like CDRE or JLL. They get involved in the PMC. So we have got a very strong team for value engineering. We have got a very strong team for procurement. We have a strong team for project management. Hence, if you look at the overall number of people, we are more inclined towards sales. You can say sales come product organization. Naturally, in terms of percentage, if you look at, it may look a little higher, but overall, if you mark to mark, see, we have got about close to about 670, 700 people. If you take the extended arm of a project management team, construction management team, and all that, maybe about 1,300-1,400 of parallel to any other organization. If you look at the percentage compared to this 1,400, it may look small. So here, not only our partners, financial partners, our customers, all our employees are treated like a partners in the firm. So it's all it's a family. We always believe in Shiram Group as one single family. I used to quote this Vasudeva Kudumbakam. So that's our philosophy and principle which build this. So people are here, but having said that, there will be small interaction. People keep jumping. That's inevitable. That's one side. On the other hand, technology is playing very important role in scaling up. So that also reduces the number of touch points. But having said that, I'm conscious about how do we build an organization from, let's say, 5-6 million capacity to 10 million capacity. Suddenly, the market consolidation can throw a bigger opportunity for us to look at a much bigger number. So I'm conscious about building the organization to look at the next level of scale.